Let's kick things off here with JPMorgan's chief U.S. economist, Michael Feroli, joining us now to give us his take on what we learned from today's numbers. A lot of talk about disinflation. Michael, are you buying it?
So I do think there were elements in the details that suggest that were favorable and that point to softer inflation readings going forward. I think a lot of the commentary we just heard was that it's too early to declare victory, and that's certainly the case. 4/10 is not a cause to celebrate, nor is 5.5 year ago core CPI a cause to celebrate. But I think when you kind of, as I say, unpack some of the details there, a lot of the inflation this month was driven by what looks like a not fluky, but volatile one-off in used vehicle prices, and it does look like rents are, coming off. And then outside of those two categories, generally things look, like they have been softening some. Again, too early to declare victory for sure, but some glimmers of hope in there.
Too early to declare victory, but I guess the big question everyone has, Michael, is it time for maybe at least to declare a pause? That seems to be the big narrative now. Even if you're not buying into the idea of a Fed pivot, is there enough data there that maybe the Fed can step back and look at the lagged effects of this year-long tightening cycle?
Yeah, I do think there is. The Fed, they say they're data dependent, but they're really forecast dependent and how they forecast that data. And I think, not only what we're seeing in this morning's numbers, but I think overall the general slowing in growth, and particularly the added headwind from tighter credit, which we saw earlier this week in that senior loan officer survey. I think when you kind of put it all together into the stew, it suggests that the forecast is that inflation should be easing over time. So I do think the Fed is setting up here for a pause. Certainly, markets are priced that way, and the Fed is really doing nothing to kind of fight that expectation. So yeah, I do think they probably ease off the next meeting.
You mentioned the senior loan officer opinion survey that just came out, probably the most read senior loan officer survey in the history of the senior loan officer survey. I am curious, though, when we start, in all seriousness, when we start to talk about this potential pullback in lending, the tightening of credit conditions, there's a big debate here as to whether this is just that, a little bit of a tightening, something that we can live with as a whole, meaning the economy as a whole, or if this is going to be that sort of credit crunch type of situation that sort of grinds everything to a halt.
Yeah, I don't think it's necessarily recessionary impulse in and of itself. I think if you had to draw a historical parallel, and they're never perfect parallels, it would be something more like the early 90s when you had the headwinds of tighter credit. Not something that slowed or stopped the economy, but it was a headwind. And that's what I would expect to be the case as we, as the situation continues to evolve over the course of the year. And again, I think that's kind of the message you got from the survey.
Of course, one of the big potential speed bumps out there right now, Michael, is all the concern about the fiscal situation, the debt ceiling, and rather the lack of negotiations going on there. Everyone has their own X date here, but I think the real question is, as we get closer to that X date, the type of volatility that we see in the markets, and more importantly, the potential disruptions in the economy, how much of that would change any of your existing forecasts for the economy going forward?
Well, I mean, first of all, if we actually have a even brief technical default, we'd pretty much have to rip up our forecasts and start anew with something that's much more dire. Now, if we, have a situation that parallels more what we saw in August 2011, that itself may not be great for the economy either. In that episode, you not only saw big moves in asset prices, but you saw big declines in both consumer and business sentiment. And that in itself, even if we eventually resolve this without a big accident, that itself could be an added headwind to the picture here, and maybe another reason for the Fed to be a little cautious.
I thought it was interesting. I mean, Jay Powell was asked about this specifically. He did say that this did come up in the last meeting as a discussion, though he made it clear that it did not factor in to the current decision, meaning the decision at the May meeting to raise rates. But of course, this will now certainly be front and center when they meet again in June, which by that time, in theory, we would have reached that X date, at least the X date that Janet Yellen herself has put out there.
Yeah, that's right. I mean, there's a possibility, there's a lot of uncertainty, but it's likely that by the time they have met in June, something will need to be done. And if it isn't, obviously that's going to take the meeting, in a totally different direction. But even if it's resolved by the time we get to the meeting, as I said, the hit to sentiment, the hit to potentially the financial markets will also be an added consideration. I think even if we make it past the current X date. And we got to keep in mind, if we resolve the current X date, there's an uncertainty as to when the next X date, is it going to be September 30th? Is it going to be next March 30th? These are things that they're going to have to keep in mind too when they're thinking about policy.